Well, good afternoon and welcome to AGH Wealth Management's 2022 Midyear Market and Economic Outlook. We're pleased you're joining us today and look forward to giving you our perspective of what to expect through the rest of what has been a very disruptive and volatile year. My name is Brian Gensch. I'm Senior Vice President at AGH Wealth. I oversee our private wealth investment strategies as well as our comprehensive wealth planning service. And I'm joined by Brad Bechtel, President of AGH Wealth, who will bring additional comments and perspectives along the way. Brad, thanks for joining us.
Yeah, thank you, Brian. Hello, everybody.
So during the call today, if you have any questions that we are not able to address, please feel free to contact us after the call and we'd be happy to address them then. Additionally, our broker-dealer LPL Financial puts out a commentary every 6 months on the markets and the economy, and that report is available upon request. So if you're interested in getting their point of view as well, please don't hesitate to reach out to either of us and we can get a report to you. So our agenda today is to go over the economic landscape, how the Federal Reserve responded to the rise of inflation, how stocks and bonds have responded, and what we can expect going forward with economic growth, Fed policy, stock bond performance, and government political environment. So full agenda today, and we appreciate your time and consideration of our outlook. As we start talking through the economy, we obviously have a lot to discuss. So, how our economic growth has slowed down, inflation has risen, the job market has continued to show tightness, and that looming R word that has been in many dinner table conversations. Many of the slides we discussed today are going to relate back to specifically what a recession call looks like or what we may expect if we are currently in one or might be in one soon, or if we even skip one altogether. So to say that over the last 3 years, our economic growth path has been through a whirlwind, a roller coaster, or a whiplash is a huge understatement, with COVID-19 literally pushing the graph off the charts in both directions of GDP, which is the measurement we have for economic growth. The echo effect to the economy was prolonged increased economic growth to out-of-control inflation that brought the last 2 GDP quarterly readings under zero. Now, this is a non-technical definition of being in a recession, and it has been for many years. When we have a GDP number that's consecutively over 2 quarters under zero, that would be a non-technical version of a recession. So some people are kind of actually calling that we're in a recession today. There was a minus 1.6% reading in the first quarter and just about minus 1% reading last quarter. So that could insinuate that we're here. However, if you strip back the GDP number and look at its components, it doesn't necessarily tell the same story. So while it's extremely evident that the economy is slowing down, one of the major components of GDP, which is consumer spending, our ability to go out and spend money, is what drives a lot of GDP. It's actually about 68% of the entire number. That portion of GDP has actually stayed positive and, in fact, in the last quarter, increased by 1%. Now, what we spend on is actually split up into 2 different sectors, the goods market and the services market. And consumption of goods did drop, but consumption of services increased, causing the positive reading. And the real reason why the first quarter showed a negative GDP was due to our net exports and our inventory changes, which happened a lot from the supply chain pressure that we've seen. And by large, what caused the second reading negative was actually those inventory changes. So again, while we've gotten 2 negative prints, it doesn't necessarily say that our consumers have stopped spending. And so the risk of recession doesn't actually have an elevated nature that it would look like just from that one reading. That's important to know as we kind of move through the presentation. That being said, we are experiencing historic inflation, so there's obviously no doubt that we're seeing prices rise. And as you can see on this graph, overall inflation has not risen to this level since the 70s. And core inflation, which takes out food and energy, because apparently that we don't need those to live, is already showing signs of coming down. However, it's the food and energy prices themselves that have remained elevated. And the reason that we strip those out isn't because they're not significant. Of course, those are two very large pieces of our household spending needs. But as you can see, food and energy actually have the propensity to go down. And so to look at core inflation is to look at what all over prices are doing. And as you can see, both are elevated, but without the food and energy piece that's been hit also by the Russia-Ukrainian war and supply chain issues, actually the rest of inflation has started to come down. And we're looking to see that happen and continue in the future, as we've already started to see energy prices coming down at the pump and oil prices coming down to $88 today. And one of the unique things about inflation is that there are really two types of inflation measured. So services and goods. So goods inflation has, for the most part, which represented in the black line on this graph, for the most part, it's been boring inflation for the last 30 years, never really increasing in prices. And a lot of that's been tied to the explosive innovation in technology that has kept prices down. However, because of the supply chain lockup that happened through the pandemic and then increased demand for goods, we have witnessed the first real major increase in this part of inflation since many of us have been investing. And as I mentioned, consumer spending or consumer expenditures in goods fell drastically last quarter. So that was a signal that the prices should start easing up on goods, which would allow for a continued deceleration in prices for the rest of the year. Additionally, while this may be somewhat of a confusing slide, there are actually measurements out there that measure what the market expects inflation to be for the next 5 years and then the 5 years following that. So really looking at a 10-year period. And as you can see, the market does not expect the next 5 years to stay elevated at the prices we're at today, and even less so over the 10-year period if you look at the orange line. And we believe this is one of the many reasons why we may have been seeing the Fed beginning to back off on their aggressive language that they've had. Another component of inflation is supply chains. And supply chains are continually showing signs of improvement, which has been a major headwind to the fight on inflation. Country lockdowns through the pandemic, as well as geopolitical risks from the Russia-Ukraine war, and of course the zero COVID policy implemented currently in China, they put major strains on supply chains. And while we see moves politically and economically to deglobalize these supply chains, that takes a lot of time. We would expect the relief in the pressure that we're seeing, along with the slowing demand for spending, to really drive prices down towards the end of the year. And one of the things this graph is showing is the black line being the global supply chain pressure, and what does CPI or inflation do a quarter later. And you can see there's a strong correlation to if the supply chain pressure is up, that inflation's up, and vice versa. All except for the pandemic period, which was an obvious dislocation of all things inflation and supply chain related. But as we can see, the supply chain pressure, the black line, has come down substantially, and we would expect that plus consumer spending dropping in the goods sector to really start driving those prices back down, which is a good thing for the economy. Go ahead.
You know, Brian, I just got back from a vacation, and I think what you've been covering here is really, really evident. I mean, just through the airports and some of the places I went, huge amounts of crowds. People are getting out. People are, the service side industry is definitely, the services are being demanded. There's a lot of people out traveling, a lot of people trying to get out and re-experience, the country. But the supply chain is also and the disruption on that was also very obvious. So if you're trying to get a rental car, for example, that is really tough sledding. You've got to reserve it well in advance, and then you're not even really sure if you're going to get it. So it was interesting. I mean, you're seeing both of these elements simultaneously just by traveling.
Sure. Yeah, I mean, and we've definitely seen it in the auto industry. I mean, if you drive past any new car dealership, you can see the scarcity of supply, and that's coming a lot from still that supply chain issue with the chip makers. And obviously, one of the things that has been recent in the news is the Chinese Taiwan conflict that could be boiling up at this point in time, and that's a big deal to the U.S. That's a big deal to the rest of the world because Taiwan is a huge producer of semiconductor chips, and those are in everything. About every electronic that we have relates back to having some sort of a chip in there that is allowing it to function the way it is, and so we've seen recently some policy changes that have maybe allowed for us to kind of deglobalize that and bring some supply or some manufacturing of that into the U.S. But like I said, that takes a lot of time.
Yeah.
And so by no means, I think, are we saying that the supply chain pressure's gone? We are showing it's easing, and that's a really good sign. There are pockets of different industries that are still have a high pressure of disruption, but overall we are seeing that decline. So another area that has clearly had pressure is the jobs market. While we started to see reductions in hirings and even some industries beginning to run through layoffs, this is still one of the tightest job markets we've ever had. With still close to 2 job openings for each unemployed person and quitting at all-time highs, it's hard-pressed to believe that companies would begin laying off their workforce at recessionary levels. Some people may look at this and say, wow, we have such high quit rates, and think, is that just from laziness or from people just not wanting to work? Actually, the quit rate is the byproduct of a tight job market where more and more people are quitting to move to higher paying jobs, which has been over the last 6 to 8 months driving up wage inflation. And that's substantially higher than from what the lows we saw in the pandemic. Only recently have we begun to see wage inflation slow down, and this is evident too of the gray line where we've also started to see job openings start to drop. But the main takeaway is we believe companies are going to be slow to laying people off. And while we have these GDP numbers that are coming in that might insinuate a recession, it's really hard to believe we can be in a recession when employment is so high and not foreseeing a huge shift in the near term. And we just got employment numbers a week or so ago of a 3.5% unemployment rate. That's the lowest we've had since 1969. So we really are looking at a tight labor market. And while we realize the labor market is not a leading indicator of the economy, it does tell us a sign of what employers will be doing for the next period of time, say 12 to 18 months. And it's going to be hard to see employers laying people off in recessionary droves due to the fact of how tight it is now and how hard it is to find good people. So those are a couple of the ways we can look at, is a recession coming? Is it here? But how do we know if we are not in a recession? Well, there are other forward-looking indicators that are out there, things like manufacturing and services, looking at those indexes, the Treasury yield curve inverting, which has gotten a lot of news lately. The markets themselves, the stock market is a leading indicator. This is also a leading indicator. It's called the Leading Economic Indicator Index. Many of these can be looked at to be helpful guides as to whether or not we're expanding or contracting as an economy. And one thing to note, just from looking at this slide, there's a lot of times the Leading Economic Indicator Index has reduced from all-time highs and recovered prior to turning negative, avoiding a recession call. Just because the graph ends how it does today doesn't necessarily mean that we're headed for a large negative measure. So this index specifically tracks 10 financial and non-financial components to try and gauge when the peak and when the trough is of the economy. And while it's obviously too early to say where this index is, if it's going to signal a recession or not, it is clear that the risk has been elevated from the beginning of the year. But there's all these other pieces with inflation and consumer spending and the jobs market that cause us to back away from a heightened sense of awareness of recession being here or coming in the next 6 months. So we don't know if we'll get into a recession or if we're already in one or not. That actually is told to us later by a group of people who decide whether we were in a recession or not. Some economists will tell you we're already there, but we believe the data just discussed would say that we may be close. But even if we are in one, there's really two main questions you should ask. How long could the recession last? And how deep will it go? And this is just a bubble chart showing the recessions dating back to post-World War II. The height of the bubble signifies how long the recession happened, and the size of the bubble signifies how deep the recession was. So obviously the size of the pandemic-induced recession, which we can see at the front, was the most severe we've ever seen. However, we recovered extremely quickly, more than we ever have, much the reason of the predicament we're in today. Too much cash sent out to a consumer whose supply chains were broken. And if you look at the one prior, the great financial crisis, it lasted a lot longer, and actually longer than many of the previous recessions, but was more of a slower bleed. Still a deep bleed, but it happened over a longer period of time. But if you continue to look back at the past, you can also see something very real here, that not all recessions are alike, whether in size or in length. So we can't really look at the last two, which has been a pandemic and the breakdown of the financial system, and decide what a recession looks like every time. This graph clearly shows that there are many forms and ways a recession happens. And so is it going to be 18 months? Is it going to be a heavy loss of gross domestic product? Those are things that obviously we'll find out later, but we don't believe just because it's happened in a long period of time for 2008 and a heavy, deep recession for 2020, it doesn't necessarily mean that we should expect that as what the recession looks like if we were to be in one either between now and the next 18 months. So naturally then we should talk about, there's another group that has the propensity to shift our perspective, sometimes by the hour or by the word, the Federal Reserve. So as you can see here, the Fed's been through almost 4 rate hiking cycles, including our current cycle in the last 20 to 25 years. These cycles are always in response to the jobs market, the economic inflation that exists through each cycle. And you can see this long drought of interest rates where we were not experiencing massive inflation after going through multiple easing cycles fiscally and then monetarily. This was when asset prices were held strong by not only fundamentals, but also by a low rate environment where it was easy to do business and spend money on homes and autos. The major difference you can see between our current cycle and the ones prior in this graph is the velocity of how fast rates went up. Flat out, the Federal Reserve took its eye off the ball, and while they were focused on job creation because of the massive layoffs we went through in April of 2020, inflation was stirring in the background, and by the time they turned to see it, it had accelerated so fast that they had to change their tone and their policy on a dime. We called it the Powell pivot. And obviously, this is why we're experiencing such volatility in the markets today. Trying to reprice the market through guessing the Fed's next move has caused a huge reduction in sentiment, as well as a breakdown in the bond investment diversification. And you can see here, the gray dotted line, that was what the Fed told us we could expect Fed rate hikes to do over the next few years. That was at the beginning of this year. The orange dotted line is the most recent Fed meeting and the new projections. In 6 months, major policy change has shocked the markets as they've pivoted hard into trying to control inflation. So this has caused another metric that we look at, the yield curve, to move. It's caused the Treasury yields to rise sharply over the course of this year. The gray line is what the Treasury rates looked like at the beginning of the year, followed by the peak aggressive Fed language, which was in middle of June. This change in the yield curve roiled the bond and stock markets, and that's measured by the black curve, the black line. Diversification broke down. For the first time, the first half of the year, bonds couldn't handle this kind of move, and they reacted fast to the Fed rate hikes and to the yield curve. And so bond prices were down, stock prices were down. The good news, however, is that the orange line is where we've landed so far. While the short end of the yield curve is still pricing in the most recent Fed rate hikes, you can see that short end still increasing. The longer end of the curve has softened, which has been a welcome to the bond markets, because that's allowed diversification to be coming back. And we've learned to not fully trust what the Fed has said, and in the last meeting, they left it wide open as to what we could expect from them for the rest of the year. So now it's back to being dependent on the data we receive about inflation and the economy, and not on what the Fed says they're going to do.
You know, Brian, that's a bit of a return to, really where the Fed has historically been in its communications. I mean, I think back to the Janet Yellen, when she was chair. That was kind of an unprecedented period of time because there was so much transparency and, projected out ahead and said, this is the data that we're looking at and this is how we're interpreting it. And this is almost more of a move back to where, if you will, into the late 70s, into the 80s, which was, okay, we're not really going to make a lot more comments about what we're looking at. So again, similar times, maybe similar measures and approaches. I guess we'll have to see.
Yeah, I think it's just trying to find that balance. I think it's what the Fed's been trying to do since 2008. After Bernanke came out with quantitative easing, I think there was a heightened sense of need to communicate to the ongoing public of what their policy was going to do, as they're rolling out these brand new features, really. And I think Janet Yellen, as you said, kind of brought a lot of transparency. And I think maybe what Jerome Powell is trying to understand is there too much transparency? If they give us too much of a door open into the discussions that they have, because I think what we probably don't realize is how often inside of a meeting they might be changing their views. Before, when we weren't really getting a lot of that transparent communication, it doesn't necessarily mean that the Fed wasn't going back and forth. It just means we weren't privy to it. And so we weren't pricing things off of each change. And I think maybe that's the one thing that Chairman Powell has learned, or at least that's what he's changed in his tone from this last meeting, is, hey, we're going to be data dependent, and we're going to stop calling our next rate hike, because they call it 50 and then they raise it 75, and we won't do it again, and they raise it again. So I think that's just a learning curve that we've had to kind of bear with the Fed, and that's we've felt it in our markets, we felt it in our portfolios, and I think that's something that has been a big learning experience for the Fed this year. So let's turn to discussing the markets and hopefully provide a healthy perspective on what we can expect for the coming months. So much of this year, we have seen an obvious pullback in the stock market, more in some areas than others. The growth market, made up of innovating companies who are putting money back into the business to grow, has been hit the hardest by interest rate changes, down over 20% year to date. The dividend paying, or the value side of the stock market, has fared much better. However, this side also did not have the same explosive growth over the last 10 years and through the post-pandemic lows. And so we've really felt that hit in really every part of the stock market. But it's clear that overall volatility has not been extremely partial. Every area of the traditional stock market, save maybe energy stocks, has seen volatility spike this year. And it's always good to remember that volatility tends to exist every single year. In fact, this graph shows what the historical intra-year pullback has done each year. The orange dots signify the pullback that year, while the black bar graph represents what the S&P 500 ended the overall year. And what we can see is that the market has come off of some pretty low pullbacks and still measured a positive return that year. Now, we're not saying to expect that this year. However, the current environment we are in would say that it's too close to tell how the market could behave going forward. It is probable that we could end the year with a negative return, but the depth of that return may be shallow. If we continue to see earnings stay positive, the Fed stay flexible, and then inflation continue to decrease. And if we want to speak about earnings, we really need to mention how incredibly profitable the market is right now. Since the 2000s, the average profit, which we measure by net margins, for the S&P 500 as a whole has been 9%, which is signified by the black graph, and then the horizontal black line is the average. Additionally, net margins have been somewhat correlated to earnings valuations. The better margins can stay positive, the better the value of the market is. But look at where we're at now. We're at historic levels in profit margins today. Another piece of evidence that says that companies will be slow to fire. There's a cushion they have that's built up in the market to allow for higher inflation prices, higher interest costs, and higher wage inflation to hit their income statements and not completely just run through all of their profits. And if we can continue to see earnings stay ahead, which so far this last quarter has been a positive sign, we can expect valuations to catch back up, which could signal a potentially strong market over the next 12 to 24 months. But it's not all rose-colored glasses. The markets can move on two major terms: valuations being too high and earnings being too low. By and large, this market volatility for the first half of the year has really been driven by revaluing what investors are willing to pay for earnings. All the uncertainty that we've seen between the inflation and the Fed and the war, that uncertainty has caused investors to decide not to pay the same for the earnings that are being put out by the stock market. So if earnings were to go into a slide, which we still believe there's a decent-sized if, then we could expect to see volatility pick back up, and instead of seeing a valuations-led pullback, now we see an earnings-led pullback in the market. So the recent shift in the markets has been well received coming off of their lows mid-June. We don't believe we're fully out of the woods with how the market can handle inflation, the Fed, and the economic landscape coming. So we still want to maintain some sort of caution as we're investing in that side of the market. Okay, this is maybe a messy graph. This may be my favorite graph, though, of the entire presentation. In fact, I would suggest that if anyone who got this far and actually stayed with us in this presentation remembers one graph, I would remember this one. And let me just explain what this is showing. So the background color in the graph represents how the S&P 500 fared 12 months from that date. And we just separated performance into 6 buckets: worse than 20% negative, negative 10 to negative 20, 0 to negative 10, and on up to greater than 20%. And so the shade of the background represents how good or bad that market performed for the next 12 months. So the darker the background, the worse the market did. And the deeper the orange, kudos to AGH branding, the stronger the market did. So now the graph that you're seeing being shown, that's the University of Michigan Consumer Sentiment Index. This basically is a measurement of how confident we feel today. June's reading marked the lowest reading since we began this index in the 70s. And I think we've already talked about all the reasons why we feel that way. But I then circled past moments in time when consumer confidence is at deep lows. And what color is the background behind those moments? You can see in almost every moment that consumer confidence was at depressed levels, the next 12-month period in the markets tended to be strong. In fact, I would suggest that this may be one of the most significant graphs showing the kind of buying opportunity that's in the market today. Yes, we have a long ways to go until the economy is out of this inflation pickle. We have a long way to go before we can feel comfortable with what is happening overseas, which are supply chain issues and with the cost of living. I would suggest that if an investor is waiting to feel better about the economy and their job and the markets before they would invest in that market, it would be deemed too late. So it's not impossible to have good markets after we get better data. So for some people, waiting may still be the best thing, but I believe that the current market environment we're in is signaling somewhat of a buying opportunity, and it would be imprudent to not at least point that out. And I apologize if it's still very confusing. We hope that this allows you to see, whether, and actually there's been an update to this graph. I didn't update, but it did bounce back up a little bit. So this technically would be kind of a trough now in that graph. So you might be thinking, well, that's great. I'm glad you want me to put more money back in the stock market where I've lost consistently for the last 6 months. But I'm risk averse. I don't feel comfortable putting my wealth at that kind of risk. What about me? And arguably, the hardest thing to be this year is a risk averse investor. The bond market has basically failed us for 6 months. We've already discussed the issues with the bond market responding to the Fed's rate policy shift, but take a little extra time to discuss the bond market in general. So the first thing to do would be to remind investors that the bond market has a very negative correlation to interest rate changes, specifically in the 10-year Treasury. You can see this graph shows that when the Treasury yields increase, bond market total return decreases and vice versa. The run-up we experienced with the 10-year Treasury, starting at under 1% at the beginning of January 2021, so over a year and a half ago, barely 1.5% at the beginning of this year, and then running hot for 6 months to over 3.5%. That has sent a tidal wave of volatility into the asset class that historically has been a great diversifier from volatility. And we've heard the reports, this is the worst bond market since treasuries were created, the worst performance of a lifetime, biggest breakdown of the 60-40 stock bond model ever. How do we recover from this? Well, first, I want to express that this has been the hardest thing as an advisor to assist clients through. Talking to other advisors all across the country, we understand how risk-averse investors lean on their bonds to provide stability. This is by and large worked for 30-plus years. And this short-term breakdown we have seen this year has increased the level of fear, anxiety, and emotion from investors whose objectives are income in retirement, capital preservation, a reduction of volatility in their portfolios. So we do believe the worst of the bond market woes are over. But we don't think that this market is one that will provide a fast recovery, though, from the prices that existed 6 months ago in the bond market. Because bond prices, historically, they don't move as fast as stocks. Having bonds down 9 to 14, in some cases, % year to date means that the waiting time for recovery has been extended. So a little bit of good news recently, as you can see, the 10-year Treasury peaked and the Fed has become less aggressive in their language. Interest rates have dropped significantly, and the price of the bond market has followed suit. So we also believe that bonds are now providing the diversification even stronger, actually, than in the last 3 to 5 years, given that they are now trading at historically low valuations, and we've seen somewhat of a peak in the Treasury yield curve. And if the Fed is correct, that they are close to normalizing rates, which we've already learned not to trust exactly what they say, but if they are correct, that they're close to normal valuation, normal rates, then it would stand to reason that carving out bonds in your portfolio for diversification has become somewhat more trustworthy than it was 6 months ago. And then additionally, for new money invested, income yields have not been this high in a long time. We believe that now is a great time to pick up better income, whether it be in the investment grade corporate market or the municipal market or others. Finding yield has been a real challenge for a decade, and now there's finally the ability to create income off of a portfolio. So taking advantage of that is key. Additionally, when we look at the lower credit fixed income markets or bonds that are from companies with higher credit risk, we can also see cyclical behavior. High yield spreads, this is a measure of how much more yield you're going to get for investing with a riskier bond than the safer bond. And this spread widens or goes up in the graph when prices are destabilizing. So the recent hit to spreads this year is what has caused high yielding bonds to perform negative 10 to 15%. But we're not running into spreads that would issue a warning of losing liquidity, which is a risk in a lower credit market. And you can see there's a relationship between credit spreads and the support line around 800. Breaking that support line is when recessions typically exist. And we've hit that short-term bouts of volatility since the Great Recession, but right now spreads are not signaling a heightened risk of liquidity. And that can be helpful to stick with this space to receive that higher income that it pays out. But all in all, while both the stock market and bond market has thrown us some curveballs this year, we don't believe this period of time calls for tightening up the hatches, but finding really opportunities to put cash to work and invest according to your long-term plan, whether that's more in the bond side of the market or the stock side. So we'd be somewhat remiss to not discuss one more place the market finds volatility, uncertainty, would be this year's election year, the midterms. So while we've discussed how every year markets can have sizable pullbacks, there's actually a stronger pullback that exists typically in a midterm election year. So this graph, you see it shows on the orange line, is the average of all years throughout this is just one calendar year. So all years, if you average them out, is what the orange line basically shows is made up of about 50 plus years. It gives a long-term historical look at how markets are favorable over time. The black line is pulling out just the midterm election years, still an average, but only averaging the returns in a midterm election year. And you can see these years tend to have a little more uncertainty. Markets are awaiting what the political landscape will look like for the next 2 years. Midterms are typically a key turning point in power, as we've seen a president now for 2 years and understand their agendas. Then we see what the power for the next 2 years may look like, allowing for us to have more certainty about policy changes. So markets tend to respond well there. The gray graph represents our current year. So the others are averages, and this is just a single year. But what we can tell is that this year is feeding those historic averages. One thing that's noteworthy in the midterm election years is that as clarity comes from the midterms, you can see how the market responds to that. And specifically, the House of Representatives typically loses, so this isn't a political statement, but the House of Representatives typically loses seats from the sitting president's party. On average, it's been about 30 seats, but it's less or more. It's usually highly correlated to the approval rating of the sitting president going into the elections. And this has historically flipped the House and caused gridlock. And gridlock, that is what markets like. Markets historically have performed much better in gridlock years than in years where one party or the other held all the majorities. So this year doesn't look like any exception to the rule, as the House has kind of had some momentum on the GOP side since the presidential elections, and President Biden's approval rating is among the lowest of any president at this time in their presidency. So the market tends to start pricing in a strong performance in October. And while we can't time the markets down to a specific month, it does lend itself to the fact that markets typically perform well following midterm election years. And the average up market from the lows of the midterm election year is actually 30%. Additionally, if you invested in November of every midterm election year and look at the next 12-month period, there's never been a negative S&P 500 return, and the average has been 15%. So there's this political cyclicality that would lend itself to the perspective of better days being ahead. So if we want to talk through this positioning for the second half, so LPL Financial, they have a large research team. I think it's one of the best in the business. A bunch of CFAs that sit around and talk every day, morning calls every market open morning. So their team puts an asset allocation and sector outlooks out on a monthly basis. By and large, we tend to follow their perspectives on portfolio positioning and would like to share with you kind of the most recent available update. We should be probably any day now getting the August outlook and are happy to discuss that with anyone with any changes that have been made. But as of July, the landscape supports domestic equities, U.S.-based companies. It supports value-based stocks as somewhat of a defense to recessionary fears, and healthcare and real estate and energy sectors. Alternatively, staying away from international stocks, specifically European and Asia-Pacific emerging market stocks, as COVID policy and war continue to drive volatility in these areas. High inflation also limits consumer spending in discretionary sectors, and high commodity prices really hurt industrial stocks. For bonds, short duration has been a better hedge against the interest rates this year, and as of July, LPL continues to believe having low duration plays to the interest rate environment. However, it could easily change if the Fed continues to move towards a more accommodative policy. Being neutral on credit, allowing just for continued investment in the space as the outlook remains supportive, staying away from localized debt, especially emerging market debt, as the strong dollar has really hurt those prospects, along with, of course, the Ukraine and Russian war, where we've seen a destabilization in those currencies. And it's been a hard space to be because, pre-war, there were some local debt, emerging market debt that really had strong financials to their countries. But the wars really disrupted that, and so maintaining a negative bias towards that, we believe going forward is still appropriate. So beyond traditional stocks and bonds, commodity investments has been a good protection this year against the increasing commodity prices. These markets tend to move fast, though, and short-term time horizon, if you're investing in this space, a lot of times a short-term time horizon is warranted. Hedged equity funds that have basically insurance is what we call it, where they put call protection, but they basically are writing insurance on the market. Those have held up fairly well through these large bouts of volatility. And they're not designed to protect completely from the downside, but they are designed to kick in insurance as volatility kicks in and escalates, like we've seen over the last 6 months. Gold's always kind of been a staple alternative investment. Gold prices have really been stagnant for years, and the recent weakness in the dollar and the continued fear index being high, gold can continue to act as an alternative investment capacity, and we've just recently seen some pricing power come back in gold prices. But we wouldn't really look at gold anymore today as the kind of safe haven investing that maybe we were used to it being for the last few decades. But we do maintain a kind of a neutral view on investing in precious metals, specifically gold. So really with that, it makes up our mid-year outlook for this year. We realize that the word recession has been on the forefront of everyone's minds. We believe that the prospects for a recession have increased this year. However, we don't believe that means investors should necessarily run for the hills. Maintaining that long-term outlook and having a financial plan both can be cornerstones in building confidence as you invest for the future and not for the past. So again, thanks for listening or watching the presentation. If you'd like to know more about anything that we said or have questions after the presentation, please don't hesitate to call or email us. We'd be happy to have a discussion with you. Otherwise, we hope this has been helpful, and we look forward to returning with our 2023 outlook next year. And again, thanks. And Brad, any closing comments?
The only thing that I would add, Brian, I mean, good job on the presentation here. I think as the markets are moving, up and down, I'm hearing more and more people, asking questions about, where should I be and how should I be invested. And, as much as Brian has said today, and I agree with it, is it's not so much about, which particular asset class you should be in. It's about a balanced portfolio. It's also about the assessment of your risk capacity. So not just your appetite, but your ability, your capacity to take risk, and then where to place it. And as Brian suggested, that's a piece of and a part of a well documented financial plan. And I encourage you to kind of look at that and think about that again, rather than in the microcosm, the greater. I think that's the appropriate way to be. So, a lot of opportunities out there, most assuredly. There's still a lot of risk out there, most assuredly. But I think with the right asset allocation that fits your appetite and your ability is where you want to be. So again, thank you all for joining us today. I really did appreciate everybody's attendance. And as Brian had suggested, please reach out to us if we can be of any assistance to you.
Absolutely. Thanks, Brad. And yeah, we really would highly recommend reaching out to us or your financial advisor if we're not your advisor. There's moments like this is really where you can enact some strategy. And one of the things I was just thinking through was, tax management of your portfolio. This is a really good time to be looking at shifts in the portfolio to kind of take advantage of maybe some of the tax environment to help on your tax returns. And there's just sometimes there's these silver linings in moments like this when the markets are volatile to know how to reposition yourself for the long-term future. And so do keep that in mind as you decide what your plans are next in your portfolio management. But we hope you enjoyed the webinar, and again, reach out if you need, but we hope you all have a safe and wonderful rest of your summer. Thank you.